Hey folks, it's Brad here. Today we're diving into a powerful momentum indicator that can help you spot turning points in the market. Let's take a look. Alright, so here's the deal. The rate of change indicator is what's called a momentum oscillator, and it shows a percentage change in a price over a specific time frame. It's pretty straightforward to calculate. You just take the current price and divide it by an earlier price. Then you just convert it into a percentage. That's it. So, for example, if you divide the current price by the closing price, say 6 months ago, then you get the 6-month ROC. Now, what's cool about this is this calculation can be applied to any type of data: stocks, ETFs, mutual funds, even economic data. And for that reason, it's a versatile tool and it can provide some really valuable insights. So here's what we're looking at. When the ROC is positive, it's a signal to buy, and when it falls below zero, it's time to sell. Some traders actually use ROC by itself as a complete trading strategy. I don't necessarily recommend that, but it is a powerful way to navigate the market's ups and downs. In fact, you can see by this chart here that just by following ROC, you would have avoided a significant loss during the COVID-19 sell-off and captured major upside when ROC turned positive again. Now, some traders like to also use ROC with a moving average. If you do that, you could identify even more precise buy and sell signals. For example, let's take a look at this chart here. This is a pretty extreme example of NVIDIA. You can see it's had some wild swings here lately, but ROC would have delivered timely buy and sell signals, and you would have captured a lot of the upside and avoided some of the painful downside. You could use a 26-week ROC with a 13-week moving average like we've done here, but you can experiment with different time periods to find out what works best for you. Now, here's why all this stuff matters. Studies have shown that high momentum stocks tend to outperform over the next 3 to 12 months. So if you can screen for stocks with the highest ROC values, you could identify some potential winners. ROC also serves as an early warning signal for potential price declines. Let's go back to our example of the S&P 500. Before the collapse, the S&P climbed roughly 400 points in just 4 months. Although the ROC wasn't especially high during this time, selling at the signal would have saved traders from about a 1,000-point decline. Here's another pro tip. You can take it a step further by combining ROC with something like Bollinger Bands. When ROC is above the upper Bollinger Band, it indicates that prices have advanced quickly and a reversal could be near. On the flip side, when it falls below the lower band, you could expect an upward move in prices. I've got a chart here of the S&P currently so you can see how that looks. That's it for today's video. Give us a like if you found it helpful. You can ask any questions or comment below, and don't forget to subscribe to our channel for more. See you next time.